What is a reverse mortgage? We have a special guest today. Mark, can you introduce yourself briefly?
Thanks, Joe. I'm Mark Richards, and I am a mortgage loan officer, and I've been doing this for 11 years. What is a reverse mortgage? In a word, it's a loan. And it's a loan that somebody 62 years or older can take against the equity that they have in their house. What's special about it is there are no required monthly principal and interest payments. But with this type of loan, you always have to pay your property taxes, homeowner's insurance, and any other home-related costs. There are three basic types of reverse mortgages, and I'm going to pretty much focus on one type, which is the home equity conversion mortgage, which actually describes what we're doing. We're converting a portion of the equity in a house into cash. It could be cash now, it could be cash down the road when of your choosing. It could be cash given to you on a very regular basis, as once a month. So the intent of the reverse mortgage program, the home equity conversion mortgage, was designed to ease the financial burdens of elderly homeowners because they're living on fixed income and they're the costs of health care, housing, and just basic living costs. And this is a way to help contribute to covering those costs while remaining in the home. So the program has been around since 1988 and is the most regulated and protected loan for borrowers that there is available for a homeowner. One thing that's special about it is before you can take the loan, each homeowner that's going to be on the loan needs to take a counseling session with a HUD-approved advisor. And they want to make sure, for the borrower's protection, that they understand what the loan is, they understand their responsibilities. They want to make sure that no one's pressuring them into getting the loan, and that they have enough of an understanding of, what are they getting into, and what is mainly their responsibilities for the loan. So it's the only loan of its kind that really does that. What's special about the loan is, I mentioned, you don't have to make monthly payments. You have the option of making a payment if you'd like to. You can make a partial payment. You can skip a payment. So there's a tremendous amount of control that the borrower has, the homeowner has, with this loan that you don't have with any other home loan. And without a doubt, it's the most misunderstood loan product that's out there in the public today.
So to be honest, before I met you, Mark, I knew very little about a reverse mortgage, and you told me in conversation that there's an acronym for it that insiders know. And can you just share what the acronym is?
Sure. We call it the HECM, which is just the Home Equity Conversion Mortgage, HECM. So what the HECM is a HECM.
Awesome.
That's our inside. That's as funny as we get in the in the home loan business. But again, as I mentioned, home equity conversion mortgage describes exactly what this loan does. We convert a portion of the equity into cash for the homeowner.
Yeah, and then many people know what a HELOC is, a home equity line of credit. How is this HECM reverse mortgage different from a HELOC?
Well, there's two or three things at least. The most important is with the HECM. The HECM, there is no time limit on the access to the money. So with a regular line of credit, the HELOC that you mentioned, you have 7 to 10 years, depending on the bank that you're working with, where you have access to the money. And also, the moment you borrow from a HELOC, you have to start making payments. With a HECM, you have access to that money as long as you're in the house, as long as you're in the loan. So that could be 30 years, 40 years. There is no actual term limit. You cannot be forced out of this loan. It's what's called a non-recourse. In other words, the agreement on the loans, the terms of the loan, cannot change by law. And so you could literally be 150 years old if you live that long and still have access to the money in your home without a required monthly payment.
Amazing. And the government started this for people 62 and older.
Mm-hmm.
And is it just an obvious answer to help the senior population?
Well, with their health costs, their basic housing costs, and just living, most people in their senior years are living on a fixed income. It's not growing, there's not much, and if anything else, people are living longer than ever, so which means it's putting more of a strain on whatever funds that they've had. So this was designed initially for the elderly, to help them stretch out their funds, because once you run out of the funds in your bank account, there's nothing there. With the HECM loan, you can actually use all the equity in your house, or virtually all, and still live there. You have the utility of living in the house, which makes it different. And the more you lean on the house, the less you have to lean on those funds in your bank account.
Right. Well, yeah, this was very eye-opening for me. Thank you for sharing with us. If this was helpful, please press subscribe so that you could see future videos.